Okay, let's unpack this. Imagine having a direct line, a shortcut, really, to the latest insights from India's central bank, a way to understand the pulse of the nation's financial system. Well, that's exactly what we're diving into today.
Hmm.
Our mission for this deep dive is all about the Reserve Bank of India's, significant developments from May 2025. You've brought us a stack of sources, articles, reports, new frameworks, and our job is to distill the most important nuggets of knowledge for you.
Yeah, think of it like a highlights reel for the RBI's recent moves.
Exactly. We'll get you well informed quickly, maybe with a few surprising facts along the way.
And what's fascinating here, I think, is the sheer range of areas the RBI has touched upon just this month. We're talking about everything from pivotal leadership changes at the very top
Right.
to the intricate rules shaping digital lending, which affects so many people now, plus a deep dive into the health of our foreign exchange reserves, and even a fresh look at the very rules about how regulations themselves are crafted.
So it's a really comprehensive, almost panoramic view.
Right. It is. It shows how the RBI isn't just managing the economy day to day, but actively reshaping the financial landscape you navigate every single day.
Absolutely. Whether you're prepping for a crucial meeting or maybe you're just, insanely curious about how the financial world truly ticks, or perhaps you simply want to feel incredibly well informed without drowning in a sea of technical data. We're going to cut through the jargon, connect the dots for you, and ensure you walk away with those satisfying aha moments. That's the goal, anyway.
Sounds good.
Sometimes the biggest shifts in an organization, they start with a single strategic change right at the top. And this month, that change came right to the heart of the RBI's leadership structure.
Indeed. We saw a really crucial leadership appointment. Dr. Poonam Gupta has taken over as the Deputy Governor of the Reserve Bank of India.
Okay.
Now, this is a very significant role within the central bank. It involves overseeing critical functions, contributing to major policy decisions that affect the entire financial system.
Right. And her term.
She's been appointed for a period of 3 years. So this appointment, it really marks a new chapter in the central bank's leadership and its ongoing strategic direction. It's kind of a foundational piece of news if you want to understand the RBI's trajectory moving forward.
Okay. Now, we often talk about the RBI being the ultimate financial regulator, setting the rules from the top down. But what if the markets themselves could play a more active role in, say, policing their own behavior and upholding standards? This concept of self-regulatory organizations, or SROs, it seems to be gaining some serious traction. Why is this such a powerful idea?
Precisely, and it's not entirely new. The groundwork was laid earlier. The Reserve Bank had previously put out a comprehensive blueprint, essentially a detailed rulebook for how financial markets can self-regulate. They'd invited applications from entities wanting to step up and function as these SROs.
Yeah.
The core idea is that these organizations play a vital, proactive role. They develop industry standards, they ensure their members adopt these standards, and they promote adherence to best practices. Think of them as industry champions, maybe, setting the bar for professionalism and conduct from within, rather than waiting solely for external regulation.
So it's about empowering the market to improve itself.
Exactly. Kind of like upgrading its own immune system, if you will.
And to make sure these SROs actually fulfill their responsibilities with independence and, integrity, the RBI has laid out some incredibly strict eligibility criteria. It's not just a rubber stamp exercise.
Absolutely not.
For instance, legally, an applicant has to be a not-for-profit company registered under Section 8 of the Companies Act.
That ensures their focus is squarely on industry welfare, not generating profit for themselves.
They also need significant financial backing, a minimum net worth of 10 crore rupees, and the capacity to build all the necessary infrastructure for monitoring and enforcement.
And beyond that legal structure, a really critical criterion is diversified shareholding. No single entity acting alone or, in concert with others can hold 10% or more of the paid-up share capital.
Ah, that's crucial. Why is that so important?
Well, it prevents undue influence from any one powerful player. It ensures the SRO truly serves the broader industry rather than specific vested interests. Makes sense, right? And their membership has to be entirely voluntary. You can't really force effective self-regulation. The industry has to genuinely buy into it and commit to upholding the standards themselves.
Governance is also paramount, isn't it?
Yeah.
I saw notes about independent directors.
Yes, very much so. At least 1/3 of the SRO's board members must be independent directors. These are people with no active association, no current ties to the entities the SRO actually serves. This helps maintain impartiality. Plus, the board needs a clear policy for rotating important positions, preventing any single individual or group from becoming too entrenched. And any major changes to the board or any adverse information about its directors must be reported to the RBI immediately. It ensures continuous oversight from the regulator.
So given these really stringent requirements, it feels quite significant that the RBI has now officially recognized the Fixed Income Money Market and Derivatives Association of India, FEMDO, as an SRO.
It is significant. It means FIMDA has successfully demonstrated its capability to meet these high standards, which is a big vote of confidence from the RBI.
And FEMD isn't new, right? They've been around.
That's right. This is a great example of an established industry body stepping up to this new level of responsibility. FEMD was actually formed way back in 1998. It started as a voluntary market body for the fixed income, money, and derivatives market, so it has a long history and deep expertise in this space.
And its membership, is it broad?
Oh yes, its diverse membership is definitely one of its core strengths. It makes it an ideal candidate for an SRO role. FEMINDA represents a broad spectrum scheduled commercial banks, primary dealers, public financial institutions, insurance companies, other financial entities. This wide representation is key to its effectiveness. It ensures the standards and best practices it develops are truly reflective of and applicable to the entire fixed income and derivatives ecosystem in India.
Okay, so let's bring this back to the listener. Why should you care about this SRO movement? Well, because when robust, independent SROs are in place, it means a more disciplined, transparent, and fair financial market overall.
Exactly. For you, maybe as an investor in fixed income products of bonds or derivatives, this means an even stronger layer of, let's say, internal policing within the industry itself.
Like the market upgrading its own immune system, as you said.
Precisely. It fosters clearer pricing, better practices, and potentially reduces risks you might not even see directly, because the industry itself is now directly accountable for upholding those best practices.
Ultimately building more trust into the very instruments you might invest in.
That's the aim.
Now, beyond these fundamental changes in leadership and self-regulation, the RBI is also drilling down into the nitty-gritty of daily market operations, making sure even the smallest gears are turning smoothly.
Yes, and that brings us to their review of trading and settlement timings. It might sound technical, but it affects market efficiency quite a bit. The RBI set up a working group, chaired by one of their executive directors, Radha Shyam Ratho, to do a thorough review. They looked at existing market timings, identified operational challenges, examined global best practices, and were tasked with recommending the way forward for these crucial market timings.
Okay, and the working group has submitted its report now.
It has. But here's the crucial part, and it really speaks to the RBI's consultative approach.
The public feedback.
Exactly. They've invited public feedback on the report with a deadline of May 30th, 2025. This means the recommendations are not final yet. It's a genuine opportunity for market participants, observers, anyone really, to provide input.
Especially since changes to trading hours can have such a widespread impact, right? From large institutions down to individual traders.
Absolutely. It affects liquidity, risk management, alignment with global markets, lots of things.
So we need to wait for the final word on that one.
Yes. We'll only cover the final recommendations and any formal regulatory decisions after the RBI has officially accepted and notified them. This measured pace, this consultation, it ensures thorough consideration before implementing significant policy changes like this.
Makes sense. Okay, so with these new structural frameworks sort of being put in place, let's zoom out now to the big picture. India's overall economic health on the global stage. And there's probably no better barometer for that than our foreign exchange reserves, the nation's ultimate financial shock absorber.
That's a good way to put it. And to truly understand India's external financial health, we regularly turn to the RBI's half-yearly reports on the management of these foreign exchange reserves. These reports, which the RBI actually started compiling way back in 2004 for greater transparency.
Right, I remember that push.
They're released twice a year, covering positions as at end March and end September. They offer a vital window into India's financial standing with the rest of the world.
And the latest one, the 44th report, reflecting the position as of end March 2025, has just been released. So, fresh data.
Fresh data indeed. Now, these reserves, they're essentially India's rainy day fund for when global economic storms hit, and they're composed of several key assets. Primarily, we have foreign currency assets, or FCAs.
Okay, what are those exactly?
They're maintained in a diversified portfolio of major global currencies. Think US dollar, euro, pound sterling, Japanese yen, maybe others. Though, importantly, they are all valued in US dollars for reporting purposes. This diversification is a prudent strategy,
Protects against swings in any one currency.
Exactly. Reduces reliance. Then there are special drawing rights, or SDRs.
The IMF's asset. These are always a bit abstract.
They are fascinating. They aren't a currency themselves, but rather an international reserve asset created by the IMF. Think of them as a potential claim on the freely usable currencies of other IMF member countries. They provide liquidity when needed.
So like a credit line almost.
Sort of, yes. Their value is based on a basket of 5 major currencies: US dollar, euro, Chinese yuan, Japanese yen, and the British pound. It acts as a global financial safety net.
Okay. And the third component?
That's the reserve tranche position, or RTP. This represents India's accessible portion of its quota within the IMF. It's essentially an unconditional line of credit that India can draw upon without conditions being imposed, and it's considered part of the country's readily available external reserves.
Got it. So FCAs, SCRs, and RTP. How did these critical reserves actually move in the latest period?
Well, during the half-year period under review, so that's end September 2024 to end March 2025, India's total foreign exchange reserves decreased. They went from USD 705.78 billion down to USD 668.33 billion.
Okay, that's a noticeable drop. What does that movement really tell us? Is it outflows or valuation changes or both?
Good question. Let's break down those reserve numbers because there are 2 important ways to look at them. If we focus purely on the underlying money flows, what the RBI calls a balance of payments basis, which excludes changes just due to currency value fluctuations.
That'll be the actual transaction.
Yes. On that basis, India's foreign exchange reserves actually fell by US $13.8 billion during the period April to December 2024. Now, this contrasts sharply with a healthy increase of US $32.9 billion in the same period of 2023.
Okay, so a definite shift there, and including valuation changes.
Even when we look at nominal terms, which does include the impact of currency value changes, the reserves still dropped. They fell by US $10.7 billion during April to December 2024, whereas they had increased by a substantial US $44.0 billion in the same period of the previous year.
So the key takeaway is?
The key takeaway here is we saw a modest drawdown, not a buildup like the previous period. It signals the RBI's ongoing tightrope walk, managing external pressures like global interest rates, commodity prices. These things directly impact everything from inflation to the stability of the rupee in your wallet.
Speaking of valuation, I saw there was a valuation gain, but it was smaller this time.
That's correct. A valuation gain of US $3.1 billion occurred in April to December 2024, but that's significantly lower than the US $11.1 billion gain during the same period in 2023. It suggests that currency movements, like the dollar strengthening perhaps, weren't as favorable this time around. Other factors were more at play in the overall reserve movement.
Okay. And beyond the reserves themselves, there's the international investment position, the IIP. How does that look?
Right. The IIP provides a crucial snapshot of our country's financial standing with the rest of the world. It's a summary record of the total stock of our external financial assets versus our external liabilities.
So our assets abroad versus foreign assets in India, essentially.
Basically, yes. During the period between end December 2023 and end December 2024, our external assets increased by about USD 79.7 billion, and our external liabilities also increased by USD 76.1 billion.
Okay, so both went up. What about the net position?
The net IIP at the end of December 2024 was a negative USD 364.5 billion.
Still negative, meaning liabilities exceed assets.
Yes, our total external liabilities are still greater than our external assets. However, the good news is that this negative gap has actually decreased on a year-on-year basis. It was negative USD 368.1 billion at end December 2023.
So the gap narrowed slightly.
Exactly. It's a positive sign for the economy's overall external financial health. We're moving in the right direction, albeit slowly, towards a more balanced position.
Now, these next few ratios, they help us understand how resilient India's reserves are against various external shocks, right? Like import cover.
Yes, precisely. For example, the foreign exchange reserves cover of imports, measured on a balance of payments basis, stood at 10.5 months at end December 2024.
Okay, 10.5 months. How does that compare?
Well, it's down from 11.8 months at the end of September 2024, so a slight reduction. This figure tells you how many months of imports our current reserves could finance, assuming no fresh inflows. It's a critical measure of our import cover.
And how do reserves stack up against debt, particularly short-term debt?
We look at that too. The ratio of short-term debt based on original maturity to reserves increased. It went from 19.1% at end September 2024 to 22.0% at end December 2024.
Okay, it increased there. What about volatile capital flows?
Similarly, the ratio of volatile capital flows, which includes things like cumulative portfolio inflows and outstanding short-term debt to reserves, also increased. It went from 67.8% to 74.3% over the same period.
So what does that increase signify? More vulnerability?
Potentially, yes. A higher ratio here can indicate increased vulnerability to sudden capital outflows. It suggests that a larger portion of our reserves might be needed to cover potentially flighty short-term capital if sentiment were to change quickly. It's something the RBI watches very closely.
Right. Now, beyond currencies and debt, gold continues to be a vital component of our reserves, doesn't it? Often seen as a safe haven.
Indeed, gold remains a significant part. As at end March 2025, the RBI held a substantial 879.59 metric tons of gold.
Wow, that's a lot of gold. Where is it physically held?
It's diversified. A large portion, 511.99 metric tons, was held domestically within India, ensuring immediate accessibility if needed. Another 348.62 metric tons were kept in safe custody internationally, with the Bank of England and the Bank for International Settlements, the BIS.
Okay.
And a smaller amount, about 18.98 metric tons, was held in the form of gold deposits.
And in value terms, has gold's share in the reserves changed?
Yes, noticeably. The share of gold in total foreign exchange reserves increased from 9.32% at the end of September 2024 to about 11.70% at the end of March 2025.
That's quite a jump. Why the increase? Higher gold prices, or did they buy more?
It's likely a combination, but certainly rising gold prices would have played a significant role. This increase in gold share reflects its growing importance as a stable asset, particularly during periods of global economic uncertainty or currency volatility.
It's a strategic hedge.
Exactly, a hedge against fluctuations in other asset classes.
Looking quickly at international investments and arrangements, I saw a note about the new arrangements to borrow, the NA, with the IMF.
Right. As at end March 2025, the RBI reported a NIL subscription under the NA. This essentially means India wasn't currently drawing on that particular IMF facility.
Okay, and regionally? Any activity with SAARC neighbors?
Yes, on the regional front, under a revised framework for currency swap arrangements for SAARC countries running from 2024 to 2027. The RBI has signed bilateral currency swap agreements with the Royal Monetary Authority of Bhutan and the Maldives Monetary Authority.
What do these swaps achieve?
They provide a crucial financial safety net for our neighbors. They offer liquidity support, typically in domestic currency, against dollars in times of need. For instance, the report mentions that Bhutan's central bank, the RMA, actually availed a swap of 15 billion rupees recently.
So it demonstrates India's commitment to regional financial stability.
Precisely, fostering regional financial stability and cooperation.
And one last point here, the investment in India Infrastructure Finance Company, UK.
Yes, the RBI has a mandate to invest up to USD 5 billion in bonds issued by this entity, IIFC UK Limited. As at end March 2025, USD 400 million had been invested in such bonds.
So that supports infrastructure development using international channels.
That's the idea, helping to channel global capital towards India's infrastructure growth ambitions.
Okay, so connecting this all back, the RBI isn't just managing reserves and interest rates.
Not at all. If we connect this to the bigger picture, the RBI isn't just managing the economy through traditional monetary policy, it's also constantly refining how it governs itself in the broader financial ecosystem.
Right.
This raises an important question. How does the RBI actually decide on new rules? How does it ensure its own process for creating regulations is robust and transparent? Almost like creating a meta framework for rulemaking itself.
That's a perfect segue, because the RBI has actually released a new framework for formulation of regulations. This standardizes exactly how it frames and amends regulations, and this sounds like a really big deal for transparency and predictability in the financial system.
It is a big deal. It means less guesswork for banks, financial institutions, and even for you, the general public, when new rules are coming down the pipeline.
So what's the core focus?
This framework clearly articulates the RBI's commitment to a more open, structured, and consultative regulatory process. It focuses on three core aspects: robust stakeholder consultation, thorough impact analysis before rules are finalized, and periodic review of existing regulations to make sure they're still relevant.
And when they say regulations, what does that cover?
It's a broad term here. It includes basically all regulations, directions, guidelines, notifications, orders, policies, specifications, and standards that the RBI issues. It essentially consolidates the process for everything under one clear, understandable policy.
And this public consultation process under the framework sounds like a clear win for public participation. How does it work?
It's quite structured. Before issuing any new regulation, the RBI will follow a clear process. First, the draft regulation, along with something called a Statement of Particulars, will be published on the RBI's official website, and they'll specifically invite public comments on this draft.
What's in this Statement of Particulars?
It's not just a brief summary. It has to include the legal provisions that empower the RBI to make this rule, the clear objectives of the regulation, and importantly, a feasible impact analysis.
Assessing potential effects before rules are finalized.
Exactly. It also needs to mention any guidance drawn from international best practices or standard-setting bodies showing alignment with global norms. It will detail how the regulation will be implemented and, crucially, provide a clear timeline for feedback.
How long do people get to comment?
A minimum of 21 days. That's provided for stakeholders and the public to share their comments. It's a significant window for you, as a concerned citizen or industry professional, to provide your input.
And then what happens with the feedback?
After receiving feedback, the RBI commits to publishing a general response to the comments received, along with the final version of the regulation. This feedback loop is essential for building trust and showing that comments were considered.
What if the final rule is very different from the draft?
That's covered too. If the final regulation ends up being substantially different from the draft, perhaps due to the feedback received, the RBI may repeat the public consultation process.
Prevents surprises.
Exactly. It ensures that stakeholders are genuinely heard throughout the process.
And beyond the public consultation, you mentioned impact analysis.
Yes, the framework mandates an impact analysis as far as possible. Before finalizing any regulation, the RBI will carry out this analysis. It assesses how the regulation might affect various stakeholders, banks, consumers, markets, and the overall financial system. It ensures that potential consequences are considered systematically and broadly, not in a silo.
And this applies to changes to old rules, too.
Yes. Any significant amendment to an existing regulation will also follow this same rigorous process: public consultation, impact analysis. Plus, the RBI commits to periodically reviewing all regulations currently in force.
Do you weed out old ones?
Essentially, yes, to ensure they remain relevant and effective. They'll update, amend, or even repeal them as needed. This prevents outdated rules from clogging up the system and ensures the regulatory environment stays dynamic and efficient.
Are there any exceptions to this whole framework?
Yes, there are certain situations where this framework won't apply. Things like internal or administrative matters of the RBI itself, or purely procedural changes that don't alter the substance of a rule. Also, regulations that apply only to specific named entities, not general application rules.
Okay. And can the RBI ever skip these steps?
There are provisions for that in exceptional circumstances. For example, if there are confidentiality needs, or if following the procedure would actually defeat the purpose of the regulation, or if there's an urgent public interest need for intervention, perhaps to maintain financial stability.
But they can't just do it arbitrarily.
No. And this is the crucial point. In such cases where they deviate, the RBI will record its reasons for deviation.
Accountability.
Exactly. It's key for accountability and maintaining trust. It ensures that exceptions are justified and transparently documented. It's not a free pass.
What about rules already on the books?
Good question. Existing regulations remain valid, but any future changes to them will strictly follow this new framework. And there's a savings clause. The validity of any regulation or action by RBI is not affected if it doesn't fully follow this framework in every single detail. This ensures continuity and avoids unintended legal invalidations due to minor procedural discrepancies. It's progressive, but also pragmatic.
Okay. Moving from that general rulemaking framework to a very specific, impactful change. This one affects foreign investors, specifically foreign portfolio investors, or FPIs, investing in corporate debt. And it seems aimed at making investment into India easier.
That's right. Previously, under the RBI's standing rules for foreign investment in corporate debt, FPI investments coming through what's called the general route were subject to specific restrictions. There was a short-term investment limit and also a concentration limit.
Can you quickly define those terms? What's the general route in corporate debt?
Sure. The general route is simply the standard, default, unrestricted channel for FPIs to invest in debt instruments. And corporate debt securities are essentially bonds or non-convertible debentures that companies issue to raise funds from investors. When you buy these, you're lending money to the company.
Got it. So what were these limits that FPIs faced?
Okay, previously, FPIs faced two main compliance burdens under the general route for corporate debt. First, there was a short-term investment limit. This restricted how much of their total corporate debt investment could have a residual maturity of up to 1 year. It couldn't exceed 30% checked at the end of each day.
Okay, limited short-term holdings.
Yeah.
And the concentration limit.
Second, there was a concentration limit. An FPI, including its related FPIs, couldn't hold more than a certain percentage of the prevailing overall investment limit set for FPIs in corporate debt. It was 15% for long-term FPIs and 10% for others.
So preventing any single FPI from dominating.
Essentially, yes. Now, the big news here is that the RBI has immediately withdrawn both of these restrictions.
Both gone. Complete.
Both the short-term investment limit and the concentration limit for FPI investments in corporate debt via the general route have been withdrawn, effective immediately.
Wow. What's the impact of that?
These changes significantly ease the compliance burden on FPIs. It makes investing in Indian corporate debt much simpler and less restrictive for them. It directly encourages more foreign capital inflows into India's corporate debt market. It's a strategic move to make India a more attractive destination, potentially deepening the market and improving liquidity.
A clear signal to foreign investors then?
Absolutely.
Okay, now here's where it gets really interesting for a lot of us listening: digital lending. It's completely transformed how many people access credit, hasn't it? Making it faster, more convenient, literally putting a loan in your pocket via an app.
It really has. The speed and accessibility are undeniable.
But with that speed came new risks, didn't they? We heard stories about hidden charges, aggressive recovery practices, data privacy concerns.
Yes, the rapid growth definitely brought challenges. The regulatory framework needed to catch up and ensure consumer protection.
And the good news is the RBI has now brought all these crucial rules together under one comprehensive umbrella.
That's right. The RBI had been issuing various directions and circulars on digital lending to regulated entities, that's banks, NBFCs, etc., often abbreviated as REs over time, piece by piece. But to bring clarity and make compliance easier in this rapidly evolving space, they've consolidated everything. It's now a single comprehensive set of rules called the Reserve Bank of India Digital Lending Directions 2025.
One-stop shop for digital lending rules.
Exactly. It simplifies things for everyone involved, from the banks and fintechs offering the loans to you, the borrower.
And I understand some crucial new instructions have been included for the first time in these consolidated directions.
Yes, a couple of significant additions. First, it includes final instructions on digital lending transparency and aggregation of loan products from multiple lenders.
Okay, what's that about?
This is all about ensuring clarity and fairness when digital lending platforms, or apps, display loan offers from multiple different lenders. The aim is to make sure you, the borrower, can truly compare offers and make an informed choice without any hidden biases or misleading presentations on the platform.
Makes sense. And the second new thing, a public directory.
Yes, the Public Directory of Digital Lending Apps, or DLAs. Instructions have now been formally issued for creating this public directory. Regulated entities, the banks and NBFCs, must report all the DLAs they use, their own or third-party ones, via RBI's Centralized Information Management System, the CIMS portal.
What's the purpose of this directory for consumers?
It's designed to help you, the customer, verify if a particular lending app you encounter is genuinely associated with a regulated bank or NBFC. It adds a layer of legitimacy checking.
But the RBI isn't vetting the apps themselves.
No, and that's a crucial point. This list is based entirely on the data submitted by the regulated entities themselves. The RBI shares it as is, without independently verifying the information on the apps listed. So, while it's a helpful guide, the onus remains squarely on the REs to provide accurate and complete data.
Good to know. And who do these directions apply to? Is it everyone offering digital loans?
They have broad applicability. They cover all digital lending activities of commercial banks, Primary urban cooperative banks, state and central cooperative banks, non-banking financial companies and NBFCs, including housing finance companies and also the All India financial institutions.
So pretty much if you're getting a digital loan from almost any major financial institution in India, these rules now apply.
That's the coverage, yes.
Now, to understand the details, the RBI defines a few key terms clearly, right? Like DLG.
Yes, definitions are important here. Default loss guarantee, or DLG, is a specific type of contractual agreement. It's where another party, maybe a fintech partner or a loan service provider, promises to compensate the lender, the RE, if borrowers default on their loans. But critically, this compensation is only up to a fixed, pre-specified percentage of the total loan portfolio.
Can you give an example?
Sure. Let's say a fintech partners with an NBFC to source digital loans. The fintech might agree to cover, say, up to 5% of any loan losses that occur within the portfolio of loans it sourced. That agreement would be a DLG.
Okay. And digital lending itself?
The RBI defines digital lending as a remote and automated lending process. It happens largely without human intervention, using digital technologies for things like customer acquisition, credit assessment, loan approval, disbursement, recovery, and ongoing customer service. Mostly online, minimal physical interaction.
The apps are DLAs.
Yes. Digital lending apps platforms, or DLAs, are simply the mobile apps or web-based platforms that provide these digital lending services. They handle functions like loan applications, credit checks, dispersal tracking, EMI payments, etc. They can be operated by the lender itself or by a third party.
Which brings us to LSPs.
Right. A lending service provider, or LSP, is essentially an agent of a regulated entity, the lender. This LSP carries out one or more of the lender's digital lending functions on their behalf. This could include sourcing borrowers, doing preliminary checks, collecting documents, or even assisting with recovery.
Okay, so the RIs are ultimately responsible, but they use LSPs. How does the RBI ensure these LSPs are up to scratch?
Due diligence for these lending service providers is absolutely crucial. It's central to borrower protection and operational accountability. The RBI mandates that any digital lending activity involving an LSP must be backed by a formal, legally vetted, clear agreement between the regulated entity, the lender, and the LSP. This agreement has to explicitly define all their roles, rights, and responsibilities. No ambiguity.
And the RE has to check them out thoroughly first.
Yes. Before partnering with any LSP, the RE must conduct strict, enhanced due diligence. This involves assessing the LSP's technical capabilities, their data privacy policies and security systems, their track record for fair conduct towards borrowers, and their overall ability to comply with regulations.
And it's not just a one-time check.
No, it's ongoing. REs are required to regularly monitor the LSP's performance and must take appropriate corrective action if any noncompliance is found. This ensures that even when services are outsourced to an LSP, the regulated entity remains fully responsible and accountable for the entire digital lending process. The buck stops with the RE, acting as your ultimate safeguard.
What about situations where one LSP works with multiple lenders? How is transparency maintained for the borrower then?
That's addressed too. When an LSP works with many lenders, the rules aim for absolute fairness and transparency for you, the borrower. The DLA, the app or platform, must clearly show a digital view of all the loan offers that actually match your specific request or profile.
Not just the ones the LSP wants to promote.
Exactly. And importantly, the app must also display the names of the lenders whose offers do not match your profile. This adds another layer of transparency, showing you who is considered but didn't make the cut for whatever reason.
Okay. And how are loans matched?
LSPs can use any fair method for matching borrowers with lenders, but that method must be consistent, clearly documented, and any changes to the method must be recorded. And crucially, the content displayed on the DLA must be neutral and objective. It must not promote or push any one RE's product over others.
So no hidden agendas, just clear options for comparison.
That's the principle. Unbiased presentation.
And disclosures to borrowers. What's key there?
Transparency is the recurring theme, as you said. REs must provide a standardized key fact statement, or KFS, to every borrower before the loan agreement is executed.
Within the KFS.
It summarizes all the essential information in a simple format: the total loan amount, all fees and charges, the annual percentage rate, APR, repayment schedule, loan tenor, details of the recovery process, the grievance redressal officer, everything you need to know up front.
Okay. What else on disclosure?
REs also must maintain an up-to-date public website. This website needs to have comprehensive details of all their digital lending products, list all the DLAs they use, their own and their LSPs, Specify the activities for which LSPs are engaged, and provide direct links to the RBI's Complaint Management System, CMS, and the Sachet portal for reporting unauthorized activities.
Centralizing information for easy access.
Yes. And one more important disclosure point: recovery agents. If a recovery agent is assigned to your case, or if the assigned agent changes, the borrower must be informed of the agent's specific details, like name and agency, via email or SMS before that agent makes any contact with you.
That prevents unauthorized people showing up.
Exactly. It provides an important layer of protection and verification during the recovery process.
Now let's talk about the money flow, loan dispersal, servicing, repayment. How are those regulated?
These rules are designed to ensure direct and transparent financial flows, protecting you from opaque intermediaries. First, loan disbursement. The loan amount must always be credited directly into the borrower's verified bank account. No exceptions unless there's a specific statutory or regulatory mandate requiring otherwise, like dispersal to an end beneficiary account.
Okay, directly to the borrower's account. And repayments.
Repayments must be executed directly from the borrower's bank account to the regulated entity's, the lender's, bank account. There should be no pass-through accounts or pool accounts managed by third parties, including LSPs, involved in this flow.
So no intermediaries controlling the funds.
Precisely. The flow of funds between the borrower and the lender cannot be controlled directly or indirectly by any third party. Also, any fees payable by the lender to its LSPs must be paid directly by the lender, the RE. These fees cannot be charged to or collected from the borrower separately. They should be built into the overall cost disclosed in the KFS.
What about defaults? Can cash be collected?
Yes. In cases of loan defaults, established physical recovery methods, including cash collection by authorized agents, are still permitted. This is an exception to the direct bank-to-bank repayment rule. However, if cash is collected, the full amount recovered must be updated in the borrower's loan account on the very same day it's collected.
And the LSP's recovery fees.
Any fees payable to LSPs for recovery services must be paid directly by the lender, RE. They cannot be deducted from the amount recovered from the borrower. This ensures integrity even in default situations.
Now, this next point sounds like a significant protection for borrowers. The cooling off period.
It is. This is a very important safeguard. Borrowers must be given a clear, explicit option to exit a digital loan during a specified cooling off or lookup period.
How does exiting work?
If you decide to exit within this period, you only have to pay the principal amount you received and the proportionate annual percentage rate, APR, for the number of days the loan was active. There should be absolutely no prepayment penalty charged for exiting during this period.
How long is this cooling off period?
The duration must be at least 1 day, but the exact period is set by the lender's board policy. It has to be clearly stated in the key fact statement.
And if you keep the loan beyond this period?
Then normal prepayment rules apply, as per existing RBI guidelines, if you decide to repay early later on.
Can the lender charge anything if you exit during the cooling off period?
A reasonable one-time processing fee may be retained by the lender, RE, if the loan is exited during the cooling off period. However, this fee must be disclosed upfront and clearly in the key fact statement.
So it gives you a crucial chance to reconsider if the loan is truly right for you without major financial penalties, like a return policy.
Exactly. A chance to back out if you have second thoughts after seeing the final terms or reviewing your finances.
Knowing how to raise a complaint is vital too. How is grievance redressal handled?
The RBI has streamlined this. Both the regulated entities, lenders, and any LSPs that have a direct interface with the borrower must designate nodal grievance redressal officers. Their contact details must be prominently displayed on websites, apps, and in the KFS.
So a clear first point of contact. What if the complaint isn't resolved?
If your complaint against the lender or the LSP is rejected, or if you're unsatisfied with a response, or if you don't receive any response within 30 days, you then have the right to escalate it through the RBI's Complaint Management System, CMS portal, which falls under the Reserve Bank Integrated Ombudsman Scheme, RBIOS.
Okay.
Alternatively, you can send a physical complaint to the centralized receipt and processing center of the RBI in Chandigarh.
And this escalation path must be clearly communicated.
Yes, this clear pathway for redressal must be explicitly communicated to you, the borrower, ensuring you know your rights and how to exercise them effectively.
Let's talk data. Data privacy and security are huge concerns in digital lending. What are the rules here?
They are paramount. The RBI has laid down strict rules. For instance, lending service providers, LSPs, are generally not allowed to store the borrower's personal information. The only exception is for some basic details like name, address, contact information, which might be necessary for them to actually carry out their specific service delivery function as defined in their agreement with the lender.
What about sensitive data like biometrics?
LSPs are explicitly prohibited from collecting or storing any biometric data unless it's specifically permitted under existing law for a particular purpose, like eKYC.
And where must the data be stored? This is a big issue, data localization.
Yes, a very important rule. All borrower data collected must be stored on servers located within India.
Within India's borders.
Correct. Now, if for some technical reason data needs to be processed outside India temporarily, it must be ensured that the data is deleted from those foreign servers and brought back to servers located within India within a strict timeline, usually 24 hours of processing. And this processing must, of course, comply with all other regulatory requirements and laws. This strengthens data sovereignty and protection, giving you more control over your sensitive financial information.
Okay. And reporting to credit information companies like Sybil.
The RBI now mandates that all lending carried out through digital lending apps, whether it's the lender's own app or an LSP's app, must be reported to the credit information companies, CICs. This applies regardless of the loan's nature or its tenor duration.
Why that important?
It ensures that your credit history accurately reflects all your digital borrowing activities. This is fair for you as a borrower. Both good and bad repayment behavior gets recorded, and absolutely crucial for the overall financial system's integrity and risk assessment. It prevents hidden debt buildup.
And REOs have to report the apps themselves to the RBI.
Yes, as we touched on earlier with the public directory. Regulated entities must report all DLAs they deploy or onboard, their own or those of LSPs they partner with, on the RBI's CMS portal. The deadline for the initial reporting was set as June 15th, 2025.
Right. Now let's dive a bit deeper into those default loss guarantees, or DLGs. There are specific rules around them, too.
Yes, very specific rules now. First, eligibility. Regulated entities, lenders, can only enter into DLG arrangements with LSPs they have outsourced activities to, or with other regulated entities that are acting as LSPs. And critically, the entity providing the guarantee, the LSP, must be a company incorporated under the Companies Act 2013.
Okay. Are there restrictions on which loans can have DLGs?
Yes, there are clear restrictions. No DLG arrangements are allowed for revolving credit facilities offered via digital lending, like digital credit lines. Credit cards are also excluded. Additionally, DLGs cannot be taken on loans that are already covered by other credit guarantee schemes, like those run by government trust funds. And they're not allowed for loans facilitated by NBFC peer-to-peer, P2P lending platforms.
Why these restrictions?
They seem designed to manage specific risks in loan categories that might already have guarantee structures or are inherently higher risk, preventing potential double counting of guarantees or excessive risk layering.
How must the DLG itself be backed? Can it just be a promise?
No, the RBI is very specific about ensuring these guarantees have real substance. REs can only accept DLG in certain forms. It must be either actual cash deposited with the lender or a fixed deposit held with a scheduled commercial bank with a lien marked in favor of the lender, or an unconditional and irrevocable bank guarantee issued by a scheduled commercial bank in favor of the lender.
So solid, easily accessible backing for the guarantee.
Exactly, ensuring the funds are truly available if the guarantee needs to be invoked.
Is there a limit on how much DLG cover a lender can take?
Yes, there's a very important cap. The total DLG cover on any outstanding loan portfolio cannot exceed 5% of the total amount disbursed from that specific portfolio at any given point in time. Even implicit guarantee arrangements are subject to this maximum 5% cap.
Why the cap?
This significantly limits the exposure of the lenders, REs, to the default risk being borne by a third party. It ensures the lenders themselves maintain adequate skin in the game and don't excessively rely on third-party guarantees, which could dilute their own underwriting discipline.
What about invoking the DLG? When does that happen?
The rules state that the lender, RE, must invoke the DLG within a maximum period of 120 days after the underlying loan becomes overdue, unless the borrower repays during that time.
Okay, a defined timeline. And how long must the DLG agreement last?
The DLG agreement must remain in force for a period that is not shorter than the longest loan tenor present in the underlying portfolio it covers. This ensures the guarantee covers the entire potential life of the loans.
And for transparency, do the LSPs providing DLGs have to disclose anything?
Yes, they do. LSPs that are involved in DLG arrangements must publish certain information on their own websites. They need to disclose the total number of portfolios they have provided guarantees for and the total amount of each portfolio that is currently under DLG cover. This disclosure must be made monthly within 7 working days of the end of each month.
Do they name the lender?
Mentioning the specific name of the regulated entity lender is optional for the LSP in this public disclosure, but the aggregate numbers provide vital transparency into the scale of these third-party guarantee arrangements in the market.
Okay, that covers digital lending quite thoroughly.
Yeah.
Now, shifting focus slightly, what's fascinating is how the RBI also delves into the very bedrock of our financial system, the banks themselves. You mentioned a couple of reports that give us a pulse check on their performance and stability.
Exactly. Let's look at 2 reports that give us insights into the health and trends within the banking sector, starting with a segment that's often community-focused.
Right. The primary urban cooperative banks, or UCBs, there's an Outlook report on them.
Yes. The Primary Urban Cooperative Banks Outlook 2023-24. This is the 11th volume of this annual publication, released by the RBI's Department of Supervision.
What kind of information does it contain?
It's quite comprehensive for the sector. It covers the financial accounts of both scheduled and non-scheduled UCBs for the financial year 2023-24. It provides aggregate information on major balance sheet items, profit and loss accounts, non-performing assets, NPAs, key financial ratios like profitability and capital adequacy. It also includes details like state-wise distribution of their offices and how much they're lending to priority sectors. For the larger scheduled ECBs, it even provides bank-wise specific information.
So a real deep dive into the health of UCBs.
Precisely. It's vital for understanding this segment, which is particularly relevant for local economies and communities across India.
How large is this network of UCBs?
It's quite vast. As of March 31st, 2024, the report states there were a total of 1,472 urban cooperative banks in India. These are split into 49 scheduled UCBs, which are generally larger, and 1,423 non-scheduled UCBs. It's a significant network of community-focused banks playing a substantial role, especially in semi-urban and urban areas outside the major metros.
And their financial stability is obviously crucial. Are there specific capital requirements for them?
Yes. Ensuring their stability is a key focus for the RBI. They have specific capital to risk-weighted assets ratio, or CRAR, requirements, which vary based on the UCB's size and complexity, categorized into tiers. Tier 1 UCBs need a minimum CRAR of 9% on an ongoing basis. But for the larger Tier 2 to Tier 4 UCBs, the minimum CRAR is higher, set at 12% on an ongoing basis.
Is that 12% effective immediately?
For those Tier 2-4 UCBs that weren't already meeting the 12% mark, the RBI set out a phased achievement plan. They needed to reach 10% by March 31st, 2024, then 11% by March 31st, 2025, and finally the full 12% by March 31st, 2026.
A gradual strengthening.
Exactly. This phased approach gives them time to build up their capital buffers gradually. This push for stronger capital is a clear move to fortify these community-focused banks, making them more resilient against potential economic shocks.
How did UCBs perform financially in the latest year covered, 2023-24?
Looking at some selected financial indicators, the trend is actually quite positive, showing improvement compared to the previous year, 2022-23. Their aggregate return on assets improved from 0.5% to 0.7%.
Okay.
Return on equity also saw a healthy jump, going from 5.1% up to 7.1%. And their net interest margin, a key measure of lending profitability, increased from 3.0% to 3.7%.
So all positive indicators.
Yes, these are all positive signs of improving profitability and operational efficiency within the UCB sector overall. It shows a generally healthy trajectory for the sector.
And geographically, where are most UCBs concentrated?
The report highlights the distribution. Maharashtra leads by a significant margin with 463 UCBs. It's followed by Karnataka with 251, Gujarat with 211, Tamil Nadu with 128, and Kerala with 58. Overall, the Western region has the maximum number of UCBs, 678, reflecting historical development patterns and economic activity in those states.
Okay, moving from UCBs to a more technical but vital area affecting the stability of all commercial banks. This is about how banks manage liquidity, essentially, how much readily available cash or easily sellable assets they need to have on hand to meet immediate obligations, especially during stress. The RBI has updated its Basel III guidelines related to this, specifically the liquidity coverage ratio, or LCR.
That's right. This is crucial for ensuring banks can withstand short-term shocks. The RBI had earlier issued comprehensive guidelines on Basel III, liquidity standards covering the LCR itself, various tools for monitoring liquidity risk, and disclosure standards. They recently put out a draft circular proposing some changes back in July 2024, sought feedback from stakeholders.
Right, the consultative approach again.
Exactly, and have now issued the final guidelines after careful analysis of that feedback. These changes aim to further strengthen bank resilience to liquidity shocks.
Okay, before we dive into the changes, can we quickly clarify those key terms again? LCR and runoff factor.
Absolutely. The LCR, or liquidity coverage ratio, is a critical metric. It's designed to ensure banks hold a sufficient stock of high-quality liquid assets, HQLA, that can be easily converted into cash to meet their liquidity needs for a 30-calendar-day stress scenario as specified by regulators.
So enough easily accessible funds to survive a month-long crisis.
That's the core idea. And a runoff factor is the percentage of a particular type of liability, like a deposit, that the regulator assumes will be withdrawn or run off during that 30-day stress period.
So a higher runoff factor means?
A higher runoff factor means that type of deposit is seen as less stable, more likely to be withdrawn quickly in a crisis. Therefore, the bank must hold more HQLA against it to cover that potential outflow.
Got it. So what are the key changes the RBI has finalized now?
Okay, there are several important adjustments. First, revised runoff rates for retail deposits that have internet and mobile banking facilities. For these deposits covering internet banking, mobile banking apps, UPI access, basically any digital channel, the assumed runoff rate has been increased. For stable retail deposits, like regular savings accounts meeting certain criteria, the rate goes up from 5% to 7.5%. For less stable retail deposits, it increases from 10% to 12.5%.
Why the increase specifically for digitally accessible deposits?
The objective here is clear. It reflects the higher potential withdrawal risk associated with digital access. Funds can be moved much more quickly and easily with a few clicks compared to traditional branch-based banking.
So banks need to hold more liquid buffers against these potentially faster outflows.
Precisely. Enhances their safety margin for the digital age.
What else has changed?
Another change concerns how deposits from small business customers, SBCs, are treated. Unsecured wholesale funding provided by non-financial SBCs will now be treated the same way as retail deposits under the LCR framework, applying those same revised runoff rates we just discussed. This simplifies the classification and standardizes the liquidity treatment.
Okay. What about the asset side? Anything on high-quality liquid assets?
Yes, regarding the valuation of government securities, which are considered top-tier Level 1 HQLA. These securities held as HQLA will now be valued at not more than their current market value, but also subject to specific haircuts. These are the same haircuts applied under the RBI's Liquidity Adjustment Facility, LAF, currently 4%, and the Marginal Standing Facility, MSF, currently 6%.
So a prudent market-based valuation with a haircut.
Correct. Level 1 HQLA generally includes cash, excess CRR, SLR-eligible government securities, and certain foreign sovereign securities. They can usually be included without limits or haircuts, but this specifies the valuation for government securities within that category.
And what about fixed deposits used as collateral?
Ah, yes, that's an interesting clarification. The treatment of pledged non-callable fixed deposits. If such a deposit, even if termed non-callable, is actually pledged by the customer as collateral for a loan or another credit facility, it will now be treated as callable for the purpose of calculating the LCR.
Why? Because it's effectively tied up.
Exactly. It recognizes the underlying liquidity risk. If the borrower defaults on the loan, the bank might seize the FD, impacting its own liquidity. So it's treated as a potential outflow, callable, from the bank's perspective under stress.
Makes sense. Any other major changes?
Yes. One more significant revision is in the treatment of deposits from certain types of legal entities. Previously, deposits from entities like Hindu undivided families, HUFs, partnerships, associations of persons, AOPs, trusts, etc., were often grouped under other legal entities, OLEs, with an unsecured wholesale funding. This category typically attracted a very high 100% runoff rate unless they qualified as small business customers.
So assumed to be very unstable?
Yes. Now, the RBI has refined this. The OLE category, attracting high runoff rates, will now consist only of deposits and other funding received from financial entities like banks, insurance companies, other financial institutions, and entities whose primary business is financial services.
Okay, so what happens to deposits from non-financial entities like trusts, partnerships?
Deposits from these non-financial entities like educational trusts, religious trusts, charitable trusts, AOPs, partnerships, LLPs, etc., will now generally be treated similarly to deposits from non-financial corporates. This means they will attract a significantly lower runoff rate, typically 40%, unless they happen to qualify as SBCs, which have the retail runoff rates applied.
So down from 100% to 40% for many of these, that's a big change.
It is. It's a practical reclassification that recognizes these deposits are often more stable than funding from other financial institutions. It frees up some calculated liquidity needs for banks without necessarily compromising overall stability.
So looking at all these changes together, higher runoffs for digital deposits, but lower for some entities, what's the aggregate impact?
It's a mix, but the overall effect seems positive for bank liquidity positions. These changes will help Indian banks manage their liquidity risks better, aligning the rules more closely with evolving global Basel III standards and the realities of digital banking. And importantly, it's being done without causing sudden disruptions.
Is there an estimate of the net impact?
Yes, the RBI estimates that the net impact of all these measures taken together will actually improve the LCR of banks at the aggregate level by around 6 percentage points.
Improve. So banks will look more liquid on average after these changes.
That's the estimate, yes. It indicates a strengthening of their liquidity buffers overall, making the system potentially more resilient during periods of financial stress.
That's interesting. And who do these apply to and when?
These new guidelines are applicable to all commercial banks, but with exceptions for payments banks, regional rural banks, RRBs, and local area banks, SACLs. And importantly, they are set to come into force with effect from April 1, 2026.
2026, so quite a lead time.
Yes, almost 2 years. This gives banks ample time to adapt their operations, adjust their liquidity management strategies, update their systems, and ensure full compliance well in advance, avoiding any sudden shock to the system. It's a measured implementation.
Okay, that makes sense. Now let's shift from regulatory changes to the hard data. Let's look at two key reports that show us exactly what's happening on the ground with money flowing into and out of our banks, that is, deposit trends and credit trends.
Right. This gives us a concrete picture of the banking sector's pulse, telling us where the money is actually moving.
Let's start with deposits. Where does this data come from?
This data on deposits comes from the RBI's annual Basic Statistical Return to Full system, often called BSR2. Under this, all scheduled commercial banks, SCBs, report highly disaggregated branch-wise data. It covers everything from types of deposits, current, savings, term, ownership patterns, household, corporate, government, age distribution of deposits, maturity patterns of term deposits, and even employee numbers at branches.
Incredibly granular.
It's extremely. It provides a fantastic view of deposit mobilization across the entire country, showing where households and businesses are choosing to put their money.
Okay, so what's the headline story from the latest Deposits with Scheduled Commercial Banks March 2025 report? How did deposits grow?
Overall, bank deposits grew by 10.6% year-on-year during the financial year 2024-25.
10.6%. Is that good? Bad? Average?
Well, while it's certainly healthy growth in absolute terms, it's actually a bit lower than the 13.8% growth seen in the previous financial year, FY 2023-24, even after adjusting for merger effects. So a slight moderation in the pace of deposit growth, but still solid.
Who holds most of these deposits?
The household sector continues to dominate by far. Households held the largest portion of total deposits in SCBs, accounting for a significant 60.2% of the total pie as of March 2025.
Over 60% from households. That's huge.
It really highlights the significant role of individual and household savings in funding the banking system in India. And within this household sector, the report notes that female depositors held a 20.7% share of total deposits as of March 2025.
Interesting. And area-wise growth? Any differences between cities and rural areas?
Yes, there were variations. Metropolitan branches, in the biggest cities, led the pack with a strong 11.7% deposit growth, indicating continued urban concentration of wealth and savings. Rural areas also saw decent growth at 10.1%. Semi-urban areas grew by 8.9%, and urban centers, non-metro cities, by 9.3%.
Okay. Any shifts in types of deposits? Savings versus fixed deposits?
Yes, a very clear shift here. Driven by the higher interest rates being offered on term deposits or fixed deposits, more money flowed into them. As a direct consequence, the share of CASA deposits, current account, and savings account deposits fell. Specifically, the share of savings deposits in total deposits decreased noticeably, falling to 29.1% in March 2025.
Down from what?
It was 30.8% a year ago, March 2024, and 33.0% 2 years ago, March 2023.
So a clear trend. People are moving money from low-yielding savings accounts to get better returns on FDs.
Exactly, chasing better returns on their savings in a rising interest rate environment.
What about the maturity of these term deposits? Are people locking money away for long periods?
The maturity pattern shows that about 68.4% of term deposits outstanding as of March 2025 had an original maturity of 1 year up to 3 years.
So mostly medium term.
Yes, it indicates a preference for medium-term fixed income options, perhaps balancing the need for liquidity with the desire for attractive returns over that time frame. Not too short, not too long.
And you mentioned higher interest rates driving this. Is that reflected in the data?
Very clearly. Reflecting the rising interest rate environment over the past couple of years, the share of term deposits earning an interest rate of 7% per annum or more rose significantly. It reached 72.7% of total term deposits by value as of March 2025.
72.7% earning 7% or more. Wow. How does that compare to before?
It's a massive jump. That share was only 64.2% a year ago, March 2024, and just 33.5% 2 years ago, March 2023.
That vividly shows the direct impact of monetary policy tightening on deposit rates, incentivizing savers.
Absolutely. It channeled funds towards these higher-yielding term deposits.
Any trends in the size of deposits? More large deposits?
Yes, we also see a trend towards higher-value deposits. Term deposits with a value of 1 crore and above increase their share in the total term deposit pie. It rose to 45.1% as of March 2025, compared to 43.7% in March 2024.
Okay. And senior citizens, how much do they hold?
Senior citizens continue to be a very important demographic group for banks. Deposits held by senior citizens made up 20.2% of the total deposits as of March 2025. This reflects their reliance on fixed income investments like bank deposits for post-retirement income and security.
Okay, that covers the deposit side. Now let's look at the other side of the bank's balance sheet, credit or loans.
Right. This data comes from the RBI's Other Annual Basic Statistical Return System, BSR1. This collects detailed information on bank credit, loans, and advances. It captures breakdowns by type of loan, the type of organization borrowing, the occupation or industry of the borrower category like individual, corporate, geographical location where the credit is utilized, the interest rate charged, and the credit limit sanctioned.
Even more detailed than the deposits, it sounds like.
It's incredibly detailed, yes. It also uses standard population group criteria for geography. Rural is less than 10,000 population, semi-urban is 10,000 up to 1 lakh, urban is 1 lakh up to 10 lakhs, and metropolitan is 10 lakhs and above. It paints a very rich picture of where economic activity is being financed by banks.
So what's the headline from the Credit by Scheduled Commercial Banks March 2025 report? Did credit growth keep pace?
Actually, no. Similar to deposits, bank credit growth also saw a deceleration. On a year-on-year basis, overall bank credit growth slowed down to 11.1% in March 2025.
Down from what?
Down significantly from 15.3% growth recorded in the previous financial year, March 2024, even after adjusting for the effects of the HDFC merger.
So a noticeable slowdown in credit growth mirroring the deposit trend.
Yeah.
Suggests a broader moderation in lending and borrowing across the economy.
That seems to be the picture, yes.
Any particular segment driving this slowdown? Private versus public banks?
Interestingly, the report highlights that private sector banks witnessed the steepest decline in their credit growth rate. Their growth slowed to 9.5% in March 2025. This is notable because they had enjoyed sustained credit growth well above 15% per annum for the preceding 3 years. So a marked shift for private banks.
What about geographically? Where did credit grow faster?
Here the trend was a bit different from deposits. The report notes higher credit growth rates in rural, semi-urban, and urban areas compared to the metropolitan centers. As a result, the share of metropolitan branches in total outstanding bank credit continued its declining trend. It fell to 58.7% in March 2025, down from 63.5% 5 years ago, March 2020.
So credit growth is becoming somewhat more broad-based geographically,
Yes.
less concentrated in the biggest cities.
That's what the data suggests, perhaps indicative of greater financial inclusion efforts bearing fruit or economic activity spreading more widely to smaller towns and cities.
What about the type of loans? Personal loans have been a big driver recently. Did that continue?
Personal loans continue to be a major force, yes. Although their growth rate also slowed down, it came in at 13.2% year-on-year for March 2025. While slower than before, this is still higher than the overall credit growth rate of 11.1%.
So they're still growing faster than average.
Exactly. As a result, the share of personal loans in total bank credit continued to rise. It now makes up 31.0% of all outstanding credit, up significantly from 24.1% just 5 years ago.
What's included in personal loans?
It's a broad category. It includes major components like housing loans, education loans, vehicle loans, credit card outstanding, loans for consumer durables, and a catch-all other personal loans category.
Any interesting trends within personal loans, housing loans, for instance?
Yes, within housing loans, there was an interesting trend regarding interest rates. There was a noticeable drop in the share of high-interest housing loans. The proportion of housing loans carrying an interest rate of 9% or more reduced to 36.8% of the total housing loan portfolio in March 2025,
Down.
compared to 54.5% just a year ago, March 2024.
That indicates a significant decline in housing loan costs for borrowers, potentially making homes more affordable, at least from a borrowing cost perspective.
It would seem so. And looking at consumer durable loans and other personal loans, excluding housing, vehicles, etc., these together now form about 1/3 of all personal loans. Here, too, the share of high-interest loans, defined as 11% or more for this segment, decreased. It fell to 47.4% in March 2025, down from 50.3% a year earlier.
So a general easing of borrowing costs for consumers across several personal loan categories.
That appears to be the trend reflected in the March 2025 data.
What about loans to industry? How did that segment fare?
Loans given to industries make up about 1/4 of total bank credit. Their growth also slowed down slightly. Industrial loan growth came in at 9.4% year-on-year in March 2025, compared to 10.4% in March 2024, a marginal deceleration.
And finally, looking at borrowers by type. Are more individuals taking loans compared to companies?
Yes, the trend towards individual borrowing continues. The share of individual borrowers in total bank credit rose further. It reached 47.8% as of March 2025, up steadily from 41.5% back in March 2020. Almost half of all bank credit now goes to individuals.
And within individuals, any data on female borrowers?
Yes, the report notes that within the individual borrower group, the share of female borrowers also went up gradually. It increased from 22.0% of individual loans 5 years ago to 23.8% in March 2025.
So more individuals, including more women, are accessing formal bank credit. That sounds like a positive sign for financial inclusion.
It does. It contributes to broader economic participation and potentially financial empowerment.
Okay, let's move into the realm of compliance now. It seems the RBI has made some very specific and practical changes to how violations under the Foreign Exchange Management Act, or FEMA, are handled, and also how foreign investments are reported.
That's right. These are crucial updates for businesses and individuals engaged in any kind of international transaction or investment. They aim to streamline processes and potentially reduce bureaucratic hurdles or penalties for certain types of non-compliance.
Let's start with FEMA compounding. First, can you just quickly explain what FEMA, contravention, and compounding mean in this context?
Sure. FEMA, the Foreign Exchange Management Act of 1999, is the primary law governing all foreign exchange transactions in India, inflows, outflows, investments, etc. A contravention under FEMA is simply a breach of any of its provisions, rules, or regulations, essentially not following the rules laid out.
Okay, breaking the Forex rules. And compounding.
Compounding is a specific voluntary process offered under FEMA. It allows a person or entity who has committed a contravention, usually unintentionally or procedural, to admit the contravention, plead guilty, and seek to settle the matter by paying a monetary penalty determined by the RBI. The key benefit is that successful compounding avoids lengthy and potentially more costly adjudication proceedings before other authorities like the Directorate of Enforcement. It's designed as a streamlined resolution mechanism, minimizing transaction costs, like an out-of-court settlement for FEMA violations.
Who has the power to compound these contraventions?
Section 15 of the FEMA Act empowers the Reserve Bank of India to compound most contraventions under the Act. There's a key exception. Contraventions under Section 3A of FEMA, which typically relate to dealing in or transferring foreign exchange or foreign securities outside authorized channels, are generally not compoundable by the RBI and are handled by the Directorate of Enforcement.
Yeah. And what kind of penalties can be imposed if a contravention is found?
Section 13.1 of FEMA outlines the potential penalties. If the amount involved in the contravention is quantifiable, you can put a number on it, The penalty can be up to 3 times the amount involved.
3 times, that's steep.
It can be, yes. If the amount involved is not quantifiable, the penalty can be up to 2 lakh rupees, or €1,000. And if the contravention is a continuing one, for example, failure to file a return persists, an additional penalty of up to 5,000 rupees, 5,000 per day, can be levied for every day the contravention continues after the first day.
Okay, so how does the compounding process actually work if someone wants to use it?
It's quite structured. First, the person or entity who committed the contravention must make a formal application for compounding. This application is typically made to the respective RBI regional office that has jurisdiction, or it can now also be conveniently submitted through the RBI's new ProbAge portal for regulatory applications.
Is there a timeline?
Yes, the RBI aims to complete the entire compounding process within 180 days from the date they receive the completed application. There's also a prescribed, non-refundable application fee, currently set at $10,000, that needs to be paid.
Does the applicant need to fix the problem first?
Yes, and this is crucial. Before the RBI processes the compounding application, the applicant must complete the requisite administrative action related to the contravention. For example, if it was a delay in filing a required return, they must file that return first. If it was a non-compliant transaction, they might need to unwind it or get post facto approval if possible. The underlying issue needs to be rectified.
Okay, then the RBI reviews.
Right. The RBI reviews the application and the nature of the contravention. If it deems the contravention compoundable, it will issue a compounding order. This order specifies the sum of money the applicant needs to pay as the compounding penalty. The applicant typically gets 15 days from the date of the order to pay this amount.
What happens if they don't pay within 15 days?
Failure to pay the compounded amount within the stipulated time means the compounding order is treated as null and void. The contravention is then referred to the Directorate of Enforcement, DOE, for further adjudication and potential penal action, which could be more severe. So timely payment is critical.
Are there situations where compounding is simply not allowed, even if the applicant wants it?
Yes, Rule 9 of the Compounding Rules, updated in 2024, specifies situations not eligible for compounding. These include cases where the amount involved in the contravention cannot be measured or quantified. Also, if a penalty has already been imposed by the adjudicating authority, like the DOE, for that specific contravention, you can't then apply for compounding.
Makes sense.
And most critically, compounding is not available if the Directorate of Enforcement on preliminary inquiry believes the contravention involves serious violations. This includes things like money laundering, terror financing, or acts that affect the sovereignty and integrity of the nation. These are carved out as too serious for the compounding route.
Okay. Now, often we hear about reporting contraventions under FEMA. What does that usually refer to?
Yes, a large number of compounding applications relate to what are often called reporting contraventions. These are typically technical or procedural violations rather than substantive ones involving illicit fund flows. Common examples include delays in filing prescribed reports for foreign direct investment, FDI inflows, delays in reporting external commercial borrowing, ECB transactions, or delays related to overseas direct investment, ODI, made by Indian companies abroad, usually about missing deadlines or submitting incomplete paperwork.
The kind of things businesses might easily miss if they're not careful.
Exactly. While still violations, they are often seen as less severe than substantive contraventions.
So what are the specific what's new changes the RBI has announced regarding these compounding directions?
Okay, there are a few important changes announced recently that aim to make the process fairer and more efficient. First, and this is quite significant, the previous rule that linked the calculation of a new compounding amount to any earlier compounding orders issued against the same applicant within a 3-year period has been deleted.
So no more escalation based on past history.
Correct. Now, each compounding application will be treated as fresh. The amount calculated won't automatically be higher just because there was a previous unrelated compounding order years ago. This is a major relief for applicants who might have had prior minor procedural violations. It encourages more self-reporting without fear of unfairly escalating penalties.
That sounds like a big positive step. What else?
Second, there's a revised process related to the payment of the application fee. Apparently, there were issues in the past with applicants paying the fee to the wrong RBI office, or significant delays between paying the fee and actually submitting the application form, causing reconciliation problems.
Administrative hurdles.
Yes. So now, to streamline this, applicants must clearly mention in their application their mobile number, the specific RBI office where the payment was made, or central office, a specific regional office, or the FEMA, and the mode they used for submitting the application itself. For example, Pro-VAH portal or physical submission.
Making it easier for RBI to track and process.
Precisely. Streamlining reconciliation and speeding up processing.
Any other changes?
Yes. One more potentially important addition. A new clause has been introduced that gives the compounding authorities some discretion regarding the maximum penalty amount in certain cases. It states that if the compounding authority is satisfied, considering the specific nature of the contravention, any exceptional facts presented in the overall public interest, the maximum compounding amount may be limited to $2,000 per contravention, per specific regulation or rule violated. This seems particularly relevant for certain categories of contraventions, perhaps the more procedural or less severe ones.
So it gives the RBI flexibility to apply a more proportionate penalty, capped at 2 lakhs, even if the formula based on 3 times the amount might have resulted in a much higher figure.
That appears to be the intent. It provides flexibility to ensure fairness while still maintaining a deterrent effect.
And these directions have legal backing.
Yes, these master directions on compounding are issued by the RBI under the powers granted by Sections 10.4 and 11.1 of the FEMA Act 1999, giving them strong legal standing.
Okay, moving from FEMA compounding to another compliance area. This one related to reporting foreign investments through the FIRMS portal.
Right. FIRMS stands for the Foreign Investment Reporting and Management System. It's the RBI's single integrated online platform where most types of foreign investments into India, like FDI, FPI in some cases, and investments made overseas by Indians, ODI, need to be reported.
And this update relates to a specific type of investment.
Yes, it relates to the issuance of partly paid units by Indian investment vehicles to non-resident investors. The underlying rules, the Foreign Exchange Management Non-Debt Instruments Rules 2019, do permit Indian investment vehicles, like alternative investment funds or AIFs, infrastructure investment trusts, or real estate investment trusts or REITs, to issue units to foreign investors where only part of the payment is made up front, with the rest due later, partly paid.
Okay, and they need to report this.
Yes. When such partly paid units are issued to non-residents, the investment vehicle is required to file a specific form, Form INDI, on the firm's portal within 30 days of the issuance. This helps the RBI track these specific types of foreign investment flows accurately.
So what's new update from the RBI on this?
The RBI issued a circular providing a one-time relaxation for past instances of non-reporting or delayed reporting of these partly paid units, specifically for investment vehicles that had already issued such partly paid units prior to the date of the circular, which was May 23, 2025.
For past issuances.
They are now being allowed a generous grace period to report these past issuances in Form INTI. They have 180 days from the date of the circular, May 23, 2025, to get this reporting done on the firm's portal.
And the key benefit, no penalty.
Exactly. The circular explicitly states that no late submission fee, LSF, will be charged if these past issuances are reported within the specific 180-day window. This is a clear amnesty or grace period for past non-compliance, easing the burden on entities that might have missed the original 30-day deadline for various reasons.
What about future issuances? Does the 30-day rule still apply?
Yes, absolutely. The circular makes it clear that any issuance of partly paid units on or after May 23, 2025 must continue to follow the original requirement. They must be reported in Form Insymbia within 30 days of issuance. The relaxation is only for past instances.
So, cleans the slate for the past, but maintains strict rules going forward.
Precisely. This clarifies the reporting deadlines and requirements for this specific type of foreign investment structure. It reduces the compliance burden and potential penalties for past cases while setting clear expectations for future compliance. A pragmatic approach. And these directions are effective immediately.
Okay, great. Now for our final section, let's go behind the scenes. Let's look at how the RBI itself manages its own financial strength, and specifically how it determines how much surplus profit it transfers to the government each year. This is crucial, right? Ensuring the central bank has enough rainy day funds to fulfill its critical roles.
Absolutely. This is about the RBI's own balance sheet resilience and its capital framework. It's fundamental to its ability to act as the nation's financial backstop. Recently, the 616th meeting of the Central Board of Directors of the Reserve Bank of India was held in Mumbai. It was chaired by the RBI Governor, Sanjay Malhotra. During this significant meeting, one key agenda item was approving the RBI's annual accounts for the financial year 2024-25. And as part of that, they determined the amount of transferable surplus for the year. Importantly, this surplus calculation was arrived at based on a revised economic capital framework, or ECF.
Oh, ECF, can you give us some background on this framework? What is it?
Sure. The RBI adopted its first formal economic capital framework back in 2019. This was based on the recommendations of an expert committee chaired by former RBI Governor Dr. Bimel Jalan.
I remember that committee was set up to look into this specific issue.
Exactly. The ECF provides an objective, rule-based, and transparent methodology for determining two key things. One, the appropriate level of risk provisions, buffers, the RBI needs to maintain against various risks it faces. And two, how its annual profits or surplus should be distributed, particularly how much should be transferred to the government of India. It's meant to put a clear, predictable system behind managing the RBI's own capital adequacy.
And what kind of risks does the RBI need buffers for?
The ECF committee specifically recognized the need for a contingency risk buffer, or CRB. They described this CRB as essentially the country's savings for a rainy day, specifically, a potential monetary or financial stability crisis.
The ultimate backstop fund.
Precisely. This buffer is consciously maintained with the RBI because of its unique and critical roles as the nation's monetary authority and the lender of last resort. The CRB is also designed to cover potential losses arising from the RBI's credit risk, for example, from lending to banks, and operational risks, e.g. system failures, fraud.
Has the level of the CRB changed over time?
Yes, the history shows a very prudent and gradual approach to building up these buffers. From 2018-19 through to 2021-22, the CRB was maintained at 5.5% of the RBI's total balance sheet size. This level was kept considering the prevailing macroeconomic conditions and the significant impact of the COVID-19 pandemic. Then, in FY 2022-23, the board decided to increase the CRB to 6.00% of the balance sheet. In FY 2023-24, it was raised further to 6.50%.
Why now for FY 2024-25, another increase?
Yes. Following the application of the revised ECF and their assessment of the current macroeconomic environment, the Central Board decided to increase the CRB target even further, setting it at 7.50% of the balance sheet size for the financial year 2024-25.
7.50%. That's a consistent upward trend. Shows a clear focus on strengthening the RBI's resilience.
Absolutely. A prudent approach to building up financial buffers to handle potential future shocks.
So after setting aside funds for this higher CRB, what was the surplus transferred to the government?
Following this decision on the CRB and accounting for other provisions, the board approved a very significant transfer of surplus to the central government. The amount approved for the accounting year 2024-25 is 2,068,590.07 crore.
Wow, that's over 2.68 lakh crore, a substantial contribution to government finances.
It is indeed. It reflects the RBI's strong financial performance during the year, likely boosted by factors like interest income on its holdings and potentially valuation gains, even after making higher provisions for its own risk buffers.
Now let's talk about the what's new in the revised economic capital framework itself. Why was it revised?
Well, the original Jalan Committee report had recommended that the ECF should be reviewed periodically, ideally every 5 years. So, in line with that recommendation, the RBI conducted an internal review of the ECF. This review considered several factors: the practical experience gained from implementing the framework since 2019, significant changes in the external operating environment, like global volatility, geopolitical risks, and modifications in the RBI's own asset profile over the years.
Okay, and the outcome?
The outcome of this internal review, including the proposed revisions, was presented to the Central Board at its meeting in May 2025, where the revised framework was discussed and approved.
Did the review find the old framework lacking?
Not really. The key takeaways from the review, as noted by the Central Board, were actually quite positive about the existing framework. They concluded that the ECF adopted in 2019 had successfully ensured a resilient balance sheet for the RBI over the past 5 years, and it had also facilitated healthy and generally stable surplus transfers to the government during this period.
So if it wasn't broken, why fix it?
Good question. Because the core principles were deemed successful, they were largely retained in the revised framework. There wasn't a fundamental overhaul.
Okay, so mostly refinements.
Exactly. While no major changes were made to the core risk assessment methodologies themselves, some important adjustments and refinements were incorporated. The aim was to further strengthen the framework, make it more robust, and ensure it adequately addresses emerging risks and complexities facing the RBI's balance sheet in the current environment.
What are the aims of the revised ECF then?
The revised DCF aims to provide perhaps a bit more annual flexibility to the central board in deciding the exact level of risk buffers to maintain within certain ranges. It allows them to better take into account prevailing macroeconomic conditions and other relevant factors each year. It also aims to enable better intertemporal smoothing of surplus transfers to the government, potentially providing a more consistent and predictable flow of funds over time rather than sharp year-to-year fluctuations.
And this revised framework is effective immediately.
Yes, it comes into effect starting from the financial year 2024-25, which is the year for which the surplus was just determined.
Okay, let's get into the specifics. What are the major changes in the revised ECF regarding risk provisioning and surplus distribution? Let's start with market risk.
Right. With respect to market risk, this is the risk of losses due to changes in market prices like exchange rates, interest rates, gold prices. The buffer requirement is now computed using an integrated approach. This means both on-balance sheet market exposures, like foreign currency assets, gold, and off-balance sheet exposures, like derivatives, will be considered together in a more holistic way to determine the required buffer. It also explicitly includes investments in foreign currency assets across all currencies, even minor ones, in this calculation.
Okay, a more integrated view of market risk. What about credit risk and operational risk buffers?
For those, the existing requirements under the 2019 framework have been retained without any change. No revisions there.
Right. Now, what about the buffers for monetary and financial stability risk? This seems core to the CRB.
Yes, here there's a significant change in approach, moving towards defined ranges rather than fixed points. The range for the buffer specifically dedicated to monetary and financial stability risk has been expanded. It's now set at 5.0% plus or minus 1.5% of the balance sheet size.
So 5.0% plus minus 1.5%. That means the target range is between 3.5% and 6.5%.
Exactly. This gives the central board the flexibility each year to maintain this specific component of the buffer anywhere within that 3.5% to 6.5% range based on their assessment of prevailing stability risks.
And how does this relate to the overall contingent risk buffer, CRB?
The overall CRB, which incorporates buffers for monetary and financial stability risk, plus the buffers for credit and operational risk, will now be maintained within a specified range as well. That range is now set at 6.0% plus or minus 1.5% of the balance sheet size.
Okay, 6.0% plus minus 1.5%. So the target range for the total CRB is now 4.5% to 7.5%.
That's correct. Compared to the previous framework, which had a target of 6.5% with a hard lower bound of 5.5%, this new range-based approach, 4.5% to 7.5%, allows for greater adaptability. The board can adjust the precise level within this range based on macroeconomic conditions and its risk assessment.
So the 7.5% they targeted this year is at the very top end of that new range.
It is, which reflects their current assessment demanding maximum prudence within the revised framework's flexibility.
What about the market risk buffers? Any flexibility there too?
Yes. The revised framework also gives the central board flexibility in setting the required market risk buffers each year. They can now set these buffers based on a resilience level measured by expected shortfall, or ES, ranging between a 99.5% confidence level, CL, at the higher end and a 97.5% CL at the lower end.
Expected shortfall. Can you briefly explain that?
Sure. Expected shortfall is a sophisticated risk measure used to estimate the potential loss in a portfolio under stressed market conditions. A higher confidence level, like 99.5%, implies a buffer designed to withstand more extreme, less frequent market shocks compared to a lower confidence level, like 97.5%.
So this flexibility means the RBI can be more adaptive, increase the market risk buffer's resilience when risks seem high, and perhaps reduce it slightly when conditions seem more stable.
That seems to be the idea. It allows them to optimize the level of market risk capital they hold, ensuring adequate protection without potentially tying up excessive capital unnecessarily when market conditions are benign.
Okay. And finally, how does the revised framework affect the surplus distribution policy, the transfer to the government?
The policy here reinforces the principle that the RBI must maintain its own capital adequacy first. A key clause states that any available realized equity, essentially accumulated profits, that exceeds the total required risk buffers, which now includes the target CRB level within its range, plus the determined market risk buffers, may be considered for transfer. Specifically, if the total available equity exceeds the required ECF level, currently implicitly linked to the 7.5% CRB target, any excess realized equity might be available for transfer, potentially allowing for some write-back from the contingency fund to income if buffers are already very strong.
But what if the RBI's capital falls below the required level?
Crucially, the policy states that if the RBI's available equity falls below the minimum required level dictated by the ECF, i.e., below the lower bound of the CRB range, 4.5%, or doesn't cover required market risk buffers, then no surplus will be transferred to the government of India in that year. The priority is to first rebuild the RBI's own capital buffers to the required minimum level.
So the RBI always ensures its own financial health and resilience before transferring funds to the government, safeguarding its ability to act as the backstop.
Precisely. It ensures the RBI maintains a healthy capital buffer at all times, safeguarding its operational independence and its capacity to manage future crises effectively.
Wow, what a deep dive that was.
Yeah.
We've really unpacked a lot today. Everything from significant leadership changes at the RBI, the nuts and bolts of how regulations are formulated with the new framework, the health of India's crucial foreign exchange reserves, and that rapidly shifting landscape of digital lending. We also looked at the nitty-gritty of banking performance, the resilience of cooperative banks, the updates to liquidity rules like LCR, and those evolving credit and deposit growth trends.
And even peeled back the layers of the RBI's own internal financial strength and its revised economic capital framework.
It covers so much ground.
It really does. And what stands out, I think, is the comprehensive and proactive nature of the RBI's work across all these areas. Every single one of these developments, whether it's about how you get a digital loan, how banks manage their liquidity buffers, how foreign investment rules are eased, or even how the central bank manages its own capital, it ultimately impacts the stability, the growth, and the accessibility of the financial services that you interact with every single day.
It's not just abstract policy.
Not at all. It's all about building a more resilient, a more transparent, and hopefully a more efficient financial system for everyone in India, quietly shaping the financial future we'll all operate in.
So, knowing all of this, digesting all these updates, what does this all mean for the future of finance in India? That's the big question, isn't it? With these strategic shifts in leadership, the push towards self-regulation, the tightening grip on digital lending practices, the refined capital frameworks, how might these nuanced changes shape the way you interact with financial services in the years to come? And what new opportunities or perhaps new challenges might arise from this constantly evolving regulatory landscape?
Definitely something to keep an eye on.
Absolutely. Something to mull over until our next deep dive.